Ladies and gentlemen, friends of the future, imagine a world reshaped not by small steps but by giant leaps. Today we stand at the edge of possibility. The question isn't whether change will come, but whether we will have the courage to bet big on it. When it comes to building wealth or preserving it over time, the first principle is simple: don't rely on a single currency. I've watched people over decades put their faith entirely into one form of money, believing it to be unshakable. But history teaches us something different. Economies fluctuate, governments change policies, and what seems stable today can become fragile tomorrow. If you tie yourself exclusively to one currency, you're exposing yourself to risks that are largely out of your control. Think of currency like a tool in a toolbox. No single tool is perfect for every job. Some are more suited for certain tasks than others. The same applies to money. Holding it in only one form is convenient, but it's not safe. Diversification across different currencies can act as a form of insurance. It's not about chasing the highest return in the short term. It's about preserving your purchasing power and ensuring that when uncertainty strikes, you're not caught off guard. I've also observed that the most successful investors think in terms of cycles, not headlines. Currencies, like markets, move in long-term waves. What may seem like a solid currency today can weaken over the next decade, while others may rise quietly in the background. By spreading exposure, you don't have to predict exactly which one will outperform. You simply position yourself to benefit, or at least remain protected, regardless of the short-term noise. Another important consideration is the global economy itself. We live in an interconnected world, and shocks in one country can ripple across the globe. Economic crises, geopolitical tensions, and policy missteps can affect even the strongest currencies. Having holdings in multiple currencies is a practical acknowledgement of that reality. It's not speculation, it's prudence. At the same time, diversification doesn't mean being reckless or careless. Choose currencies wisely with attention to stability, long-term prospects, and economic fundamentals. There's no need to spread yourself across too many. Select a few with strong track records and a history of resilience. Balance is key. Ultimately, avoiding over-reliance on a single currency is a mindset. It's about humility, recognizing that no single system is infallible, and being prepared for whatever the future holds. Wealth is not just the amount of money you have, it's your ability to maintain purchasing power, to preserve options, and to seize opportunities when others are scrambling. By thinking broadly and planning prudently, you make it far more likely that your financial position remains strong. Even when the unexpected occurs, history will continue to teach lessons. The prudent investor listens and adapts, ensuring that no single currency or system holds undue sway over their future. Patience, judgment, and preparation. These are the qualities that endure. There's a timeless principle in wealth building that rarely changes. Even as markets evolve, it's far safer and wiser to own real things. By real things, I mean assets that have intrinsic value, businesses, land, productive property, commodities, things that produce value or utility regardless of what the next headline says. Paper promises and abstract instruments may fluctuate wildly, but tangible, productive assets have a staying power that cannot be ignored. Too often, people are enticed by what seems easy, liquid, or trendy. They pile into financial products that offer excitement or leverage, thinking they'll outsmart the market. But these are bets, not ownership. True ownership gives you a claim on something that exists in the real world and will likely retain value even when sentiment shifts. Land, a well-run business, natural resources, these are not fantasies, they are the bedrock of long-term wealth. One of the critical benefits of owning real things is that they create opportunities. A business generates earnings, a property can produce rental income, and commodities can provide a hedge in uncertain times. They offer a form of stability that purely financial instruments rarely do. You are not speculating on the next rumor or trend, you are participating in the ongoing creation of real value. This distinction is subtle but important. Owning real things aligns your wealth with the underlying drivers of prosperity, rather than with mere perception or sentiment. It also encourages patience and discipline. Real assets do not usually provide quick thrills, but they compound in value steadily when chosen carefully. Markets may be volatile, but a productive asset will continue to function, to generate output, to serve a need. Owning real things requires study, judgment, and selective focus, not a flurry of transactions. Those who understand the underlying value of what they hold are rarely swayed by short-term noise. Furthermore, owning real things can provide protection against uncertainty. Inflation, currency fluctuations, and financial crises are easier to weather when your wealth is tied to tangible assets rather than paper promises alone. The physical and productive nature of these holdings provides a buffer against risk and preserves purchasing power over time. It's not speculative, it's prudent. In the end, wealth is built, preserved, and enhanced not by chasing every hot trend or fleeting investment, but by thoughtful ownership of what truly has substance. Real things endure. They create value, generate returns, and provide a margin of safety in uncertain times. Those who focus on owning them are not just protecting their wealth, they are participating in the processes that make economies grow, that sustain communities, and that shape the future. It is not glamorous and it is rarely fast, but it is effective. Patience, discernment, and a commitment to substance over style will always pay off in the long run. One of the simplest but most powerful principles in managing wealth is understanding that diversification is protection. It's not a strategy for excitement or a shortcut to outsized returns. It is a way to preserve your capital and reduce the likelihood of catastrophic loss. Many investors underestimate the importance of spreading their assets across different areas, assuming that one winning bet is enough to carry them forward. History, however, teaches a different lesson. No single investment, no matter how brilliant, is immune to unforeseen events. Diversification works because it recognizes the limits of prediction. We can study companies, economies, and markets, but uncertainty is inevitable. Political changes, economic shocks, technological disruption, and natural events can all affect outcomes in ways we cannot foresee. By holding a mix of assets, different sectors, geographies, currencies, and types of investment, you reduce the risk that any single event will derail your financial future. Protection, in this sense, is the core goal. It's important to note that diversification is not about spreading yourself too thin. Holding 100 investments you do not understand does not create safety. It creates confusion. The real power comes from thoughtful allocation, choosing a range of high-quality holdings that are resilient and have growth potential. When one investment struggles, another may thrive. The balance between them smooths volatility and keeps your overall portfolio on a steadier path. Another benefit of diversification is psychological. Markets are volatile and emotions can lead to poor decisions. When all your wealth is concentrated in one area, fear and panic can tempt you into selling at the worst possible moment. A diversified portfolio allows you to stay calm, to think clearly, and to maintain conviction in your long-term plan, even when headlines are alarming. Protection is as much about your mindset as it is about your money. Diversification also positions you to seize opportunity. When risk is spread thoughtfully, you have the confidence to invest in emerging trends, new industries, and innovative companies without jeopardizing your entire financial position. You can take calculated risks because the foundation of your wealth is solid. That balance between prudence and opportunity is what creates enduring results over time. Ultimately, diversification is a form of insurance against bad luck, unforeseen events, and errors in judgment. It is not a substitute for diligence, research, or understanding the assets you hold. Rather, it is a complement to those efforts, ensuring that when things do not go as planned, your financial future remains intact. By embracing this principle, you protect yourself from the unpredictable, give your investments room to grow, and position yourself to benefit from long-term trends. The rewards of patience, careful selection, and broad exposure are profound, and they underscore a timeless truth: protecting what you have is just as important as seeking what you might gain. One of the most overlooked but powerful approaches to wealth and investing is understanding that everything moves in cycles. Economies, industries, markets, and even individual companies experience periods of growth, stagnation, and renewal. Recognizing these long-term patterns allows you to position yourself in ways that short-term observers often miss. The key is patience and perspective. What may appear as chaos or uncertainty over a few months or even years often fits neatly into a larger rhythm when viewed over decades. Short-term fluctuations are unavoidable. Prices rise and fall, sentiment swings wildly, and headlines grab attention. It's easy to be swayed by the noise, to feel compelled to act on every uptick or downturn. Yet those who succeed over the long run are the ones who resist this impulse. They understand that cycles are natural, inevitable, and repeatable. By identifying where we are in a cycle and maintaining focus on the fundamentals, you gain an advantage that is invisible to most participants. Thinking in cycles also teaches humility. No single trend lasts forever. Booms give way to busts, and busts eventually lead to recovery. By acknowledging this, you avoid overconfidence in temporary highs and undue fear in temporary lows. This perspective encourages measured decisions, careful analysis, and a willingness to hold when others panic. There is enormous value in staying disciplined and not being driven by short-term excitement or fear. Another important aspect is recognizing that innovation itself moves in cycles. Industries that seem stagnant today may be on the verge of breakthroughs that will redefine the landscape. Conversely, sectors that are currently dominant may face disruption as new technologies, consumer preferences, or regulations emerge. Those who think long-term cycles are not merely reacting to the present, they anticipate the future and position themselves to participate in the next wave of growth. Finally, thinking in cycles reinforces the importance of patience and compounding. Wealth, like most natural processes, grows slowly at first and accelerates over time. The long-term cycles of markets, businesses, and economies allow compounding to work its magic, but only if you resist the temptation to chase quick wins. By keeping a broad, multi-decade view, you're able to take advantage of downturns, maintain discipline during booms, and stay aligned with the forces that ultimately drive lasting value. In the end, understanding long-term cycles is not about prediction or speculation. It is about observation, discipline, and alignment with enduring patterns. It allows you to see opportunities where others see risk, to remain patient when the world is impatient, and to grow wealth steadily while others chase fleeting trends. Success is rarely a sprint. It is a marathon guided by insight, patience, and the ability to ride the waves of cycles with calm judgment and unwavering focus.